The gold market has done this only 3 times in its history. I'm going to give you the answer and wrap up the week for you in just a couple of seconds. But first, it's Friday, October 24th, 2025. This is your weekly wrap-up. Hope you all had a great week. This shows you the answer in this historical chart. What I'm talking about here, gold has only had 3 major breakouts in its history, so it's only corrected 3 times after a major breakout, and that's where we are here and now. That's the very big picture of the gold market. We are having our first big post-breakout correction. This was the 3rd major breakout in gold's history. This was the 2nd here in 2005, breaking out from this downtrend, this multi-decade base. And then, of course, we had this breakout here in 1972, the greatest breakout of all time in capital markets history, as I've coined it. And as I also point out, silver, when it clears 50 convincingly, that's going to be the 2nd greatest breakout of all time. But I digress. So, first breakout here, 2nd breakout here, 3rd breakout. And this breakout was to a new all-time high, much like this breakout. So this is the 2nd most significant in its history, far more significant than this breakout here. But those are the 3, and the arrows show the first real post-breakout correction. Now, in the 70s, you did have this here, which was, I believe, 12%. So you had that, but this was really the first significant one. This was actually 28% over 4.5 months. Now, if I'm making the comparison for where we are here and now, as I've said in other videos, we're probably somewhere in between. We're not at the level where it would be a 28% correction, but we're also past this point where it would only be a 10 or 11% correction. So that's the historical comparison. We ran up here. This was May of 2006. So this, in terms of time, this corrected about 5 months. So this is about a 5-month correction. This was about 4.5 to 5 months. So that's what I'm looking for with this correction right here. Again, there's an element of price and time. So a 5-month correction, well, the price damage might all be done in a month or 2. So keep that in mind. So that's where we are in the very big picture now, specifically wrapping up the week. We can see here the large sell-off, the hard down that we experienced in precious metals, which happened in the last week. You see here the miners, really a hard down here in the miners. GDX from 85 down to a low of almost 70. GDXJ about 112 here on the high, down to the low 90s. So really a 20% decline in the juniors, or at least very close to it, in about a week's time. And there's other juniors. These are the junior indices. So 20% down in GDXJ. There's other juniors that are down 30, 35, 40%. So that's why it's important to understand when you have a real correction in this sector and in the stocks, you can get hit. Know what you own, know what it's worth. That's going to help you navigate these corrections better and buy and hold better. So that's where we are now. Zooming in, talked about it last week. Here's the daily candle chart of gold here, daily candle chart of silver. Here's the gold-silver ratio. This is one area I'm looking at for a gold correction. 3,700, that's about 15% down. But looking at the pure price action, you did break out from this bull flag here. You gapped up. Then you had a very strong move in less than 2 months. And so looking closely at the price action, this is a level where I think you're going to find good support, 3,700. Initially, you might find a little bit more support here. Where would that be? 3,900, maybe a little bit higher. You could find some support there, a little bit below, but 3,700 or thereabouts, that's going to be the strongest level of support for gold. Here's the 200-day moving average. I've sketched in here how it could evolve. So it's very possible that if gold were to dribble down here below 3,900, it's probably going to test the 200-day moving average sometime in the winter. That'd be my guess. Okay, now with respect to silver, this is the area I'm looking at here, 40 to 42. It's a bigger area. If you watch my other video, you know why I have the 150-day moving average here. And that is coming up, or I should say, that could come up like this as I've sketched in. And so that's going to get to the mid-40s before the end of the year. Now, again, looking at the pure price action, the low 40s, that's what I'm looking at for silver. Gold-silver ratio, obviously, you're in a correction, gold outperforms. So that's where we are. One more look at the metals. Here's the weekly chart, and that's a peak. You get this kind of a candle after a big run-up. That's a peak. You saw it here last week. We had, I believe this is a bearish shooting star candle in silver, confirmed by this nasty down candle this week. So we can see here, looking at where we might get support, again, it's around 42. Low 40s or a little bit above. You look at gold, 3,600. This is what I'm looking at. Let me delve into this a bit more. So you had the break. It was a gap up and a breakout, really strong candle. Then gold slowed down a little bit. Then it shot up here the last 1, 2, 3, 4 weeks. So this area between these two sharp moves, gold should find support in here if it comes down to that level. Same thing with silver. You had the gap up. You had the breakout. Then not entirely similar to gold, but we can see the last 4 or 5 weeks, it really shot up. So you have the breakout here, somewhere in between. That's where support should be found. Okay, so that's the short and medium term currently for gold and silver. But let's go back and take a very big picture view with gold, because I do want to mention that. I've updated this chart, and this is one of my favorite charts of gold, all-time high, breakout analog. And so if you don't know, what I'm doing is I'm looking at historical breakouts in gold to new all-time highs, and I'm putting them on the scale of the current breakout, which began that breakout move at the end of February of last year. So this is 1972. The 1972 breakout is on the current scale. So this is a way to compare these historical moves to what has transpired in recent months. And we can see here the black line, that's where we are here and now. That's the breakout. Again, the breakout move it occurred last March. That began at the end of last February. And there's other breakout moves as well. So I've combined them into these averages here. You can see this is 1972 and 2009. And then when 2009 ends, I continue it with 2005. So that's a line here. This is another one where I'm looking at all 3 of those. I didn't include 1978 to 1980 because that thing went off the charts. That was like this. It went straight up like that. So the current breakout is not following that. And I wanted to be more reasonable and a bit more conservative, removing that. And so I removed that, but I added that breakout. Remember, the 2005 breakout, as I showed you here, it wasn't a breakout to a new all-time high, but that was really significant. The third most significant breakout of all time in gold, the second most being the current one. So I've added that here. So this is just a combination of the 1970-2005 breakout. It's this middle line right here. This middle of these 3 average lines. And so the middle line reaches 6,700 at the end of February 2027. So let me do my math. We're at the end of October, the end of February. Oh, that's 16 months gold could be at 6,700, potentially based on history. And let's look at the analog and see where we are here and now. We are very similar to some of the averages. And what happened a couple months back? Well, the averages were at this level, and then they corrected for about 5 months. They corrected down here. Then they moved significantly higher after that correction. So it's possible that we could correct for 4.5 or 5 months. I pointed out comparable corrections lasted about 5 months. So it's possible this corrects like this, then it starts to move higher like that in 2026. So again, this is a very big picture. Keep it in mind. This is where we're going in the very big picture. But to get there, if you need corrections along the way, look in 1972. This was 28% down. This was another 23% down to get up to this level, which I believe is about 9,200. I haven't put it in here, so I apologize for that. But 1972 is the best comparison for where we are here and now in this current bull market. But we're a little bit behind it. We're not quite as strong. So that's why I like this line here, the 72 in 2005, because we're stronger than 2005 as we should be, not quite as strong as 1972, which is where we should be. So I think in between those two, the average, I think that's the best representation for where gold is. Now, moving on, before we wrap things up here with the stocks, I just want to say thank you to all of you who have joined the Daily Gold Premium. I appreciate you and your business so much. And if you have not joined yet, and you own minors and juniors, and you're looking for some guidance, you've come to the right place. We at the Daily Gold Premium, we are looking for a combination of the best quality companies, but also those that have the most upside in this bull market. So that's what we are trying to marry together. Quality companies, quality assets, value, but at the same time, they have 3x, 5x potential over the next 2 or 3 years in this bull market. And again, thank you to those who have subscribed. I really appreciate you. And if you haven't subscribed yet, but you own juniors and you're looking for some guidance, there's no better option here. Head on over to thedailygold.com/premium. We'll love to have you come aboard. And without further ado, let's get to the stocks. So here are the weekly candles for the silver stocks. SIL here, SILJ at the bottom. Love these thumbnails so we can zoom in on the last few months of candles. And look, we talked about it. Really ugly candle. The market was making a top. What happened this week? 8% down in SILJ. SIL probably down the same amount. I haven't checked it. You can see the candle here. You just have nasty bearish candles here. They've clearly put in a peak here and here. And now the question is, where are they going to find support? So this is SIL right here. You had the major breakout here through the high 40s. And if we zoom in here on the candles, looking at the price action, this is one area I would look at. Because you do have a gap here. It did fill, but we did have this strong move here in SIL. Then you had a consolidation for a little bit, and then it just zoomed higher before it topped 2 or 3 weeks ago, started topping. So in between, when I'm looking at just this price action, I see this is an area here. You could see initial support here. This is another area here, call it 58, and then maybe 56, 57. So again, this is at 60, close the week at 67. This is probably the area I think this falls into. Upper 50s and upper 50s. That's what I'm looking at here for SIL. Now, SILJ, here's a support here at 16. And so for SILJ, looking at the candles here, I would say 17, that's going to be a support level. And then here where you had the gaps, which I think did fill. So around 19 to 17, close at 22.84. So 19 is not that far away. But people, when you see charts like this, they're going to peak. These moves don't last forever. So that's where we are. The junior silver stocks will continue to correct. Same thing with the junior gold stocks and the larger gold stocks. I mean, again, look at these candles. These charts are similar. Okay. 1, 2, the last 3 or 4 weeks, these are very bearish candles. Now, the moving averages that I put in here, this is the equivalent to the 200-day exponential moving average. Now, usually I use the simple moving average, but the 200-day exponential moving average has proved to be support for corrections during strong uptrends in bull markets, in gold stocks. So keep an eye on these moving average lines here. And so trying to assess when these ETFs could find support. Here's GDX. So I would say this is probably worst case. It closed at 72.80. This is probably worst case would be here. Call it 57, 58, 59. So call it, I'd probably say 60. That's a good area to look at. For GOEX, here's a gap here at 55, so keep an eye on that. And by the way, look at the moving averages. Again, these are the 200-day exponential moving averages. This is already at 56. This thing will come up higher like that and get into the 60s. Same thing here with this one, and same thing for GDXJ. So GDXJ here you have the gap right about 80, close at 94. So those are also levels to keep an eye on. Now, final thing, focus on individual companies and individual stocks. Now, it's important to know how all these charts look and what the sector's doing in the sector trend, but it's even more important if you own individual stocks to follow those closely, because some are going to be buys really soon, and it might be 2 or 3 or 4 months before others are buys. That's it for the week. Thank you so much for tuning in. I appreciate your support so much. Hope you had a great week. Hope you have an even better weekend ahead. And last thing, please leave a comment. Let me know what you think. Would love to hear from you. Thank you, and have a great weekend.